Memo to young employees who are joining startups and promise stock options. Do not do anything rash. Hey everyone, this is Kevin the Apptrepreneur, and we've got to talk about a sad story today. Although, unfortunately, the sad story involves someone who did something very stupid, and so therefore I want to talk about this, not necessarily to absolve him of his guilt, because I think this is a lesson he probably needs to learn, but I think it's a lesson maybe some of you need to learn as well. So, an engineer got hired at Bolt, big startup electric vehicle company, and he borrowed a lot of money to exercise some stock options. And then the problem was he got laid off. He's now on the hook for tens of thousands of dollars, and he believes the IPO for those stock options could be years away, if ever. And I think this is a very valuable lesson to learn for anyone who joins a startup, so let's talk about it. So, a former engineer at the financial technology startup Bolt took out a loan of nearly $100,000 last year to exercise his stock options, with the hope that he could avoid the several $100,000 tax bill. But just a few months later, he was laid off along with more than 200 others for about one third of the workforce. Now he has 90 days to pay back the loan for the number of shares that vested. In October, the firm permitted employees to exercise their stock options early and began providing traditional recourse loans, which allow employees to borrow money collateralized against their personal assets to help employees afford the cost. Bolt uses Carta as its equity management platform, and NASDAQ Private Markets is the trading venue where all these transactions take place. The loans themselves are funded by Bolt and not any outside party, a spokesperson said. Ryan Breslow, the founder and former CEO of Bolt, touted this as the most employee-friendly stock option program possible in a lengthy Twitter thread announcing the initiative. And here's the thing, it probably is to a certain extent. I mean, they probably made buying into the company much easier than it otherwise would have been. And here's the thing, there's a reason why a lot of companies put up with these terrible or a lot of these employees put up with these terrible companies that are startups and low pay and lack of sleep and lack of a life, because if they go public, they usually get stock options and then they become millionaires overnight. And a company that's on the that's like, all cutting edge and everything like that, and by the way, it appears that I was wrong. It's not a electric car company, it's a financial thing, but, sorry. Hey, the ability to buy into your own company, like maybe that means that employee, if they're invested in the company, is more invested in the company working. Maybe they're less likely to take days off. I mean, there are some things I could see that would be good, but the problem is what happens if you lose that job and now your employer holds the loan and they want you to pay it back. That's where this starts getting messy. Companies commonly gave this option to employees during the dot-com boom and subsequent bust, which almost cost some tech employees their life savings. Today, the practice is more uncommon because the large risk it poses for employees. Quote, to early exercise is a personal decision with meaningful tax implications that could provide tax benefits depending on the individual's specific tax profile and the value of the equity, a spokesperson for Bolt told Insider via email, adding that the firm could not predict what the fair market value of the shares would be at the time of exercise, and as a result, there were both benefits and risks associated with this decision. The former employee who spoke with Insider on the condition of anonymity, because he was not authorized to discuss the matter with the press, said he decided to take the risk because Bolt was coming to a close on its Series D, which would increase the value of its shares significantly. Bolt offered him $100,000 worth of share with 0% interest at a discount of $1.50 a share against the firm's latest valuation of $5 a share. A spokesperson with Bolt confirmed the recourse loans were offered at 0% interest but declined to comment on the valuation of the shares. Of course. Because the former employee was terminated before the end of his 4-year vesting schedule, he's left with tens of thousands worth of vested shares. Now he needs to either pay this loan out of pocket, sell the shares on a secondary market, or hope that Bolt agrees to buy back his shares at or above $1.50 a share to recoup the cost of the loan. None of those look very likely, I want to say, just as someone who invests in the market. That's not very good. He said the latest Bolt stock transaction through Forge, a marketplace where investors and employees can trade shares of private startups, sold at $28 a share in March. There are currently open offers at $18 a share, but there have been no buyers recently, he added. Quote, I'm a little worried about paying it back. I have the savings, but not sure I want to give money to Bolt at this point for an IPO that would be years away, if ever. The firm, which has raised $966 million today on an $11 billion valuation, according to a Bolt spokesperson, has mostly skirted questions about committing to an initial public offering. When TechCrunch asked Breslow earlier this year if becoming a public company was near, he said it was not on the immediate horizon, nor the end goal. And by the way, as a company, you usually want to go public. That's how you raise money. That's how you raise capital. That's how you have leverage to negotiate better deals. Private companies can be very successful, but people who run private companies tend to be happy with just being profitable. They don't want to grow at all costs. If you don't want to grow at all costs, and most tech companies and financial institutions do, then a company that says we're not thinking that going public is the end goal, that's a red flag. Whether the company can get to profitability or IPO, I would say it's 50-50 at this point, the former employee said. Okay, here's the significant down risks for employees. When startup employees receive options, the most significant downside is that they may lose out on a profit if shares lose their value, said Zach Levin, an attorney and the founder of Law by Levin, a law firm that provides legal advice on startups. When it comes to a recourse loan, if the shares don't become valuable, these employees are on the hook to repay an entire loan, which they might not be able to afford. So you potentially bought shares that are now worth nothing, Levin said. Bolt's financial viability is not clear, with the information reporting that the firm burned $60 million in the first quarter of 2022 and had expected to top a whopping $250 million in burn this year before layoffs. Quote, if the team focuses and executes over the next few months on in-progress deals, then they can bootstrap the network effect of shoppers, the engineer said. Without that, the business will be clearly failing well before we run out of cash. Even if the firm doesn't go under, there may be further difficulties. For one, if Bolt decides to forgive these loans and cancel the employee's debt, the IRS might see the loan as income from the firm and may pursue the employee. So, that's not going to happen. Additionally, options exercised with this loan may still be regarded as, quote, unexercised, which would result in the employee losing the planned tax benefits of using the loan. We're talking about some pretty serious downside risk, Levin said. It's yet to be seen if current and former employees at Bolt who exercise this option will regret this decision or get a financial windfall. But the former engineer told Insider that the financials and mismanagement at Bolt concerned him. Quote, people who joined after the last funding round would be in a much more difficult position, he said. Most are really not sure about the long-term viability of the company. I think Bolt's success or lack, therefore, will be clear before the runway expires. And this is why you really have to think twice before making decisions like this. This kid, and I'm sorry, my nose is itching, so it's kind of distracting to be honest. This is not the person. This person is this is like a stand-in, I think. But this person, probably got sucked up in the whole, startups are worth this many billions of dollars. Look at all the money that's coming in. It's going to be worth this much. But we're starting to see the chips crumble. And that's one of the reasons why I've started my The Gig Is Up series with Uber and brought me back to the topic, because it was basically something I predicted. And now I'm just enjoying watching the downfall. What I don't enjoy is watching employees basically take bets with their lives that do not pay off. This kid could be in some serious trouble in many circumstances. Unless the company really ends up becoming profitable and going public soon, he'll probably be forced to file for bankruptcy as the only way to really secure his future. And it's going to be tough. And I kind of wonder what startups are going to look like going forward, because we are kind of in a dot-com bubble thing where companies say, hey, come on over, work for us, we'll pay you in stock. There was a Simpsons joke when they were putting Angry Dad on the internet as a webtoon, I believe, and Lisa asked the CEO, do you have a business model? Do you have an economics plan? Do you have merchandise? Do you have any way to move forward? And the CEO just kind of looks at her and says, here, have some more stock. And that's kind of what it is. And unfortunately, this kid listen to his company. And you should never just listen to your company. Always get a second opinion, an outside opinion, and have them explain the pitfalls, because the company obviously wants you to give them money and to invest in themselves. Maybe they were being predatory. I don't want to assume too much, but maybe the company really needed money and they figured they were going to offer some stocks at a discount, and they were going to also offer the loan to get some money because they needed the books to look better. Who knows? But I wish this kid had talked to a lawyer or a financial counselor outside of this company, because the company has interests and they usually don't align with yours. But anyway, I would like to know what you think about this story. Who do you feel bad for the kid, or do you think, nah, he deserves it? And what do you think of these kind of deals? Would you ever take it? I'd love to know. Comment below, like, favorite, share, subscribe, and as always, flame responsibly. Have a good one.